Hi everyone, Happy New Year and thank you for tuning in. Tesla reported vehicle production and deliveries for January 2, and looking at in the fourth quarter, they stated they produced over 439,000 vehicles and delivered over 405,000 vehicles in 2022. Overall, vehicle deliveries grew 40% year over year to 1.3 million, while production grew 47% year over year to 1.37 million. Following this news, Tesla's stock was down double digits as much as 13% on the day after these results were posted. And so you might be asking yourself as an investor, why is Tesla's stock falling so much after it reported such nice, healthy growth? I mean, isn't 40% growth really good? And yes, it is really good. 40% growth would be really good for any company, right? But here's why that's a major risk and why the stock was down so much on the day following the results. It's not just that Tesla grew by 40%. This is the reason. Now pay close attention to what I'm going to show you here. In Tesla's outlook, it says this is their long-term outlook. It was in their most recent shareholder letter, and this part is can be found in nearly all of their shareholder letters, and they reiterate this claim very often, right? So this is a common theme. All analysts that are following Tesla stock are well aware of this, which is that they plan to grow their manufacturing capacity as quickly as possible. Over a multi-year horizon, they expect to achieve 50% average annual growth in vehicle deliveries. So when analysts are forecasting Tesla's stock valuations and creating financial models for Tesla stock, they could be using this 50% figure in their models. So when Tesla reports growth of just 40% in a year in vehicle deliveries, that goes against their model, their valuation models, which had 50% contained in there, right? So if they need to update that model downward, that's going to create downward pressure on the valuation, because now these analysts are telling their clients that you've got to be more careful with Tesla stock. We're lowering our price target for Tesla stock, or we're increasing the risk for Tesla stock. That's why this is one major risk that Tesla stock investors need to pay close attention to, is this 50% target that Tesla has long claimed it's going to be able to achieve. Now, it does say over a multi-year horizon. So that means that Tesla doesn't expect to exceed 50% every single year. It's just saying over the course of 3 years, you might have 1 year that's below 50, and then you'll have one that's above 50. And on average, if you average out 3 or 5 years, will be above 50%. Okay, so that's in Tesla's defense. However, with the macroeconomic headwinds rising, right, the fears of a recession worldwide are increasing as the Federal Reserve has rampantly increased interest rates, not just here in the US, but central banks worldwide have increased interest rates. Consumer balance sheets and consumer incomes are being stretched, and so they don't have as much money to be spending on an electric vehicle, the price of Tesla, right? They might choose for lower cost vehicle options. And then on top of that, competition is flooding into the market with EVs. Nearly every car company now has an electric vehicle option or multiple electric vehicle options. And so consumers now have choices on what car to choose. Yes, you can say Tesla is the best in class and it has one of the better models and better range and all of that. Yeah, that might be true, but customers have choices now, and some of them are going to choose another option instead of a Tesla, whereas if there was no competition, they may have gone with Tesla. And even if they still choose to go with Tesla, the increase in competition means that Tesla is going to be paying more for the components it needs to produce its cars. So regardless if customers choose competitors or not, it's going to be a headwind to Tesla. So investors and analysts are worried that Tesla may need to revise this outlook downward. They may come out and say, okay, you know what? This 50% average annual growth is not realistic. We need to lower that target to 40% or whatever they lower it to. And when that happens, believe it or not, the stock price is likely to fall by 15 to 25, maybe even 30%, as much as 30% on the higher end. Although I will say that that might be a little extreme. It's just when I'm comparing it to other companies, for instance, if you go back and look at what happened to Twilio. Twilio is a software stock. When they had a similar target of 30% annual growth for the long term, and they removed that guidance and said, okay, that's no longer realistic. Right when they announced that, on the day after, the stock fell by 20%. So if you compare that with Tesla, you can say, okay, maybe Tesla stock could fall by 20% on the day following such an announcement. But given that Tesla has so much hype in terms of its long-term growth built into the valuation, you could see the stock fell 12% on the day after missing its delivery target, right? So if it could fall 12% just on missing one quarter's target, imagine how far the stock will fall if they revise and lower this long-term target. So this is one major risk that investors should be paying close attention to, and the risk of this happening, just the probability of this risk happening, just increased dramatically. Just increased dramatically by these latest quarter's figures. So if you've been following my channel, this should not be new to you. I've been highlighting this risk, but what did change now with the latest delivery update is that the probability of this risk happening in 2023 just increased, right? If they continue to post lower than 50% deliveries over the next quarter or 2 quarters, the pressure is going to mount for management to come out with a revision to this target, to tell investors to give investors a more realistic target that they think they can achieve over the long term. All right, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.